Hello and welcome to Crux Investor. We caught up earlier today with Ian Berzins, who is the CEO of Braveheart Resources. And if you want our thoughts and opinions on that conversation, the company itself and its plans for next year, you can catch that at cruxinvestor.com/club, where you can also find detailed company reports. There's commentary from experts from around the world on a variety of companies and commodities. There are training videos on there. There are summaries of other interviews that we have done to save you some time. Of course, there is a thriving community of investors sharing their thoughts and ideas with each other in a safe environment. So go along and join them at cruxinvestor.com/club. Of course, we love your feedback too. So do give us a like, leave your comments below. And if you want to see what we talked about, take a look in the description. Ian, how are you doing, sir?
Well, thanks, Matthew.
Well, thanks for joining us. Relatively new story to us. We've not met or spoken before, so I'm looking forward to hearing all about it. First of all, where in the world are you?
We're in beautiful downtown Calgary, Alberta, Canada.
Oh, very nice. I haven't been there for a long, long time. And how's life in Calgary at the moment?
It's balmy today, 10 above, but we had snow for the last couple weeks before. So we're Chinooking right now.
You're Chinooking. Oh, that's a great phrase. Chinooking. Hey, well, why don't we Chinook over to your 1-minute overview and I'll pick it up from there.
Great. Braveheart is a junior mining company, kind of moved through the exploration, now in the development phase. We have one principal asset called the Bull River mine. It's an underground mine with copper, gold, and silver. And we're in the very late stages of acquiring a second asset in Ontario, Canada, near Pickle Lake, called the Thierry mine. And it's quite a bit larger asset. It was previously operated by Umex back in the late 70s, early 80s. So we'll have two principal copper projects. The Thierry project, we're in the late stages, just waiting final approval from the TSX, and the party that's selling us the property, they have shareholder approval for the sale. So that's relatively imminent.
Beautiful. Okay. Well, thanks for that introduction, first of all. I'm really keen to understand a little bit about the business plan. I always am. I always start with that because both projects have something in common, that they're both being past producers. But before we do that, can you tell me a little bit about you? What's your track record of having created shareholder value?
Yeah, sure. So, I mean, by training, I'm a mining engineer, graduated Queens many decades ago. I've worked virtually my entire career in Canada, between copper, gold, oil sands, and coal, principally. Most recently, prior to joining Braveheart about 2.5 years ago, I was VP GM at Thompson Creek's Mount Milligan operation, which is currently run by Centerra. So quite a little bit bigger project, 60,000 ton a day project. And prior to that, I was 6 years with Sand Gold in southeastern Manitoba, where we brought that up to about an 80,000 ounce per annum operation for a full 3 years while I was chief operating officer. So I've been on the ground. I've worked a lot in the Northwest Territories, actually 6 provinces, 3 territories in Canada, a lot in the north, so places where infrastructure is important. And I've had a chance to work closely with First Nations as well in all jurisdictions. So in terms of raising money, it's been a combination of raising money to bring projects forward. This one, you know, we've really changed what Braveheart is. So at this point, when I joined back in May of 2018, we were kind of a 4 million market cap company, trading at about 10 cents with one principal asset. And now today we're up over 20 million, more shares out there, but kind of trading around 13 cents in that range this morning. So in terms of shareholder value, I think we're really on the precipice of really a breakout. I think as our story gets better understood, we're trying to differentiate ourselves versus a lot of the junior mining space in Canada. You know, we're not project generators. Most of us are miners. What we're trying to do is to take assets that are arguably, they've been past producers, they have resources in place, and can be brought into actually into production in 3 to 5 years. So we're currently on that timetable with Bull River. and arguably we can do the same thing with Thierry. We'll plan to do that. So our intent is actually to be operators, and so we will drill, but it'll really be to support the assets we have or to upgrade the quality of the resources at those properties.
Right. Okay. Help me understand this. You've been there 2.5 years. You've come from, big companies before, big producers before. Why on earth would you join a small company like this?
Well, partly I'd been on the road a lot. The previous 10 years, I'd been commuting weekly either to northern British Columbia or to Winnipeg, Manitoba from Calgary. And so that takes a beating on you. I'm in Calgary. I'm not saying I was semi-retired, if you will, but I got asked to join a group of guys that had initially a small project that was a high-grade gold. And so I got to stay busy. So it's allowed me to kind of build the company and bring in new assets. And frankly, I'm only 4 hours away from our primary asset, so I can be there as often as I need. So it's a comfortable situation, and so at this point in time, Calgary is a logical place for me to be personally. And with the assets we're looking at, they're all within practical distance to get to on an as required basis.
So it's just easier for you. You've had enough of
just either
being on the road.
I've worked for the bigger companies, and you get to that point where I also we want to put a stamp on this that it's really ours. And I've been part of senior management teams and larger senior management teams, but we've got a strong insider shareholding base, and we just wanted to do something a little bit different.
Okay, so Braveheart's been around a long time. Okay, they've been through various stages. Hasn't really done anything up until beginning of 2019. I guess, is that when Bull River was introduced to the portfolio? Yeah,
correct. I mean, the history of Braveheart is it morphed from a junior called Rainbow Resources, which was publicly traded in Toronto. A guy. One of our directors was on that board, and David Johnston is the founder of Braveheart. David had acquired a number of fairly grassroots exploration targets in central British Columbia. So when I joined in May of 2018, we had an option to acquire a past-producing, high-grade but challenging little gold mine near Nelson, British Columbia. So in the first 6 months while I was on board, I was looking for a practical location where we could actually mill the ore. So the mining, it was high grade, 16 grams, but narrow and flat, so not conducive to mining. But in my search for a mill, I stumbled across a situation near Cranbrook, British Columbia, which was really a mine that in late May petitioned themselves into bankruptcy protection or restructuring. We were the first guys on the doorstep, and we looked and said, this is an advanced project that's been kind of under the wire. It had been privately held, so off the radar screen, and we just saw some tremendous value if we could basically unscramble the mess that had been made. And so it took us from initially, I visited the property in late May. We made our formal offer in September, and through the different hurdles with getting it through the TSX and approvals, we finally were able to announce the successful acquisition through the CCAA process on January 19th. So that really changed our world. We let the option agreement on the gold mine expire. We still could go back and look at it at a different point, but this is much more of a company maker. So we said this is a really good starting spot for us.
Right. Well, let's talk about that, because I think the market agreed with you. That you saw a significant rally in the share price. The market was interested, and then a kind of slow, gradual decline down into obviously the despair of March this year, and there's been a sort of bit of a recovery since. So again, I'm just trying to get in the mindset of the management team, okay? Because you were looking at something else, you stumbled across by accident this private, well, unfortunately unsuccessful operation in the shape of Bull River. Did you? What was the conversation internally? Because you were looking at it from a milling perspective, and then you said, well, actually, hang on a sec. This is attractive to us. What we've been doing up until now has not resonated with the marketplace. We haven't got the market cap, the interest, ability to raise capital to do yet another small, whether it be high grade or otherwise mine. Maybe a change of plan is needed. Was it that kind of conversation, or was it just, well, we'll take anything that comes along?
No, I think it's a bit of that. I mean, what we had was what I would consider a fairly expensive option agreement, ultimately having to pay about $4 million to secure ultimate 100% interest in this gold mine. Now, the gold mine, we had a 43-101 report that we actually had about 140,000 ounces at about 14 to 16 grams. So not a bad little project, but pretty small. It really didn't get anyone too excited. Plus, where it was in Nelson, British Columbia, some challenges in trying to get permitted, and it was up at elevation, up at 7,000 feet. So you can imagine that you might even be looking at a seasonal operation. So we said we can't be sporadic, drill it for 3 months a year, and then sit on the drill results, and then the permit process. So I would say it was a bit fortuitous that when I went to look at Bull River, what I found there was a fully developed surface infrastructure that it was lacking a flotation and a filtration circuit. It did have it, and it does have a permit to actually mine tons underground, but it was a fully developed underground mine down 350 meters, which to me was just unheard of. So then the question really came is, do we have the stomach to go after this? And what are we going to have to pay? Because we really thought we might be bidding against some bigger boys. And so we weren't trying to be too cheeky, but we tried to put something on the table that made sense. So while other parties came to the table with simply an asset purchase sale on a dollar value, we got creative and offered what's called a plan of arrangement in British Columbia, where you actually take care of all parties. So we renegotiated with the two senior secured creditors that were treated pari passu. One was extremely difficult and had been the main reason this thing had found its way where it was. The other had been the previous dip lender, and so they were very comfortable with. They needed a mining team. They weren't mining guys that held it. So we looked at that. We actually we took care of the unsecured creditors. We actually gave them 30% of what they were owed, but in shares of the company. And then we offered the underlying shareholders an opportunity to purchase Braveheart shares by converting their share position. Now, we had 2,900 individual shareholders in Purcell Basin Minerals. We offered every one of them, regardless of their shareholding, 5 shares for every share they held. And ultimately, if somebody didn't have at least 2,000 shares, we added an administrative fee. So we said, in order to do the transaction, it's $1,000. And so it was not, we thought that was a nominal amount to make sure that we basically cleaned the thing up. And ultimately, we had 118 previous shareholders from the company that elected to pay $1,000 to convert their holdings and became Braveheart shareholders. So we added about 16 million Braveheart shareholders on that transaction, just with the underlying Purcell.
Fantastic. So there's a few things going on there, because again, some of the questions been sent in to us is like, well, what's the history to this? Okay, so it's a private company, it had not been run well. Let's just take a look on the ground. You said there are a bunch of things missing because they weren't miners, they didn't know what they were doing, or they didn't have the money to actually complete the job.
Well, a bit of both. Now, originally between 1970 and 74, the mine was run effectively or efficiently by Placid Oil, which was 2 of the Hunt brothers behind it. And they mined 2 small open pits. I think they did okay. They were mining at about 1.7% copper with the silver and gold as well. But they weren't underground people. When they tried to collar a portal to go underground, they chose a poor location, had struggles with it caving, elected to sell it. So it finds its way into private hands between 1976 and 2010. And the particular principle of that, a fellow named Ross Stanfield, they kind of bounced around like a ping pong ball with what they were going after. So clearly, it's always been a copper, gold, and silver mine. 70, 8% copper, 15% gold, the rest silver, generally speaking. That's what it is. That's what the resource is right now. And so they chased what they thought was rhodium and platinum and palladium and a whole bunch of rare earth minerals. And they told a pretty good story, but they raised between $200 and $300 million over that time frame. And they put that into roads and drilling campaigns. They didn't do a whole lot of surface upgrades, but they did drive 22 kilometers of tunnels. So we've inherited, if I was to drive those tunnels today in the underground, it would cost us about $60 million. So they actually sealed out or drifted on structures on 7 different horizons. So we're already in the ore body on 7 different horizons down to 350 meters, which significantly reduces potentially the capital going forward. So really what happened is in those final years between 2010, Stanfield passes in 2010. It gets into a very complicated initial restructuring under Deloitte and comes clear of that in 2014 with the $10 million dip investment by what was at the time called Cuveris, and they've been now renamed 216687 Alberta. So same guys. They are now shareholders of Braveheart, but they got involved initially as the dip lender. And from my perspective, had they been mining guys, they could have and probably should have been able to bring this operation back into production. They face the same challenge we do, is that in the Placid days, the surface tailings pond was completely reclaimed. They actually won an award for reclamation. So it was reclaimed, and so there's currently no capacity for tailings disposal at the mine today. There's lots of real estate, but there's no permit. So we're in the process of trying to get what would be a new permit to deposit tailings, initially on surface and then ultimately back underground. And then we'll need a new effluent discharge permit. So that's the process these guys were working on up until 2018, when they just simply ran out of gas and couldn't raise any more money.
Okay, so tell me where you're at now. So apart from the tailings permit, you're applying for it. You say in your document you're fully permitted otherwise. I mean, what does that mean?
So we have permission. We could mine at 200 tons a day from the underground today. Gotcha. But a 200 ton a day mine at 1.7% copper, it doesn't work. So no. It's got to be larger. So,
right.
So basically, we're looking to get permission to mine up to the ball mill, which is usually what you look at for the throughput of the mill. The ball mill is run at can run at 700 ton a day. We're looking to get our mining permits so we can mine up to 1,000, just to give us some room to work. But the surface, the front end, which is the crushing plant, is capable of about 3,500 ton a day. So it's grossly oversized for the mill. The grinding circuit is already in place. What we have to replace in the mill is the flotation circuit, because we'll be producing a copper concentrate, kind of a 25% copper concentrate. And then, different than in the past, what they did is they then pumped the tailings at 35% solids out to a traditional or conventional tailings impoundment. And but what we're looking to do instead is we're going to utilize as one of the best available technologies is filtered tailings, or what's sometimes referred to as dry stack. So the idea with the dry stack is that post Mount Poly, which was Imperial Metals in 2014, they had a major dam failure, which caused a lot of angst in the province, and it was understood around the world. But that failure of a conventional tailings pond forced some new regulation, new discussion, new recommendations from an expert panel on how these facilities should not only be built, but managed. In 2007, I was involved with the first probably dry stack operation up at Minto, which is in the Northwest Territories under Sherwood Copper. So we put in a dry stack facility. Now, typically you do that in an area that might be more mountainous. So you get away from the large impoundments, the large earth structures, which obviously also have effluent inside. And if there's any kind of topping or failure, then they fluidize and you have yourself some problems. And that's happened around the world, including Brazil. So with dry stack, it's effectively what you do. You've got to add some cost to the milling process, but you dewater to approximately 10 to 12% moisture, and then you can actually convey that or truck that out to a laydown area, and then you would place it. So in the early years, our intent is to use dry stack on surface as a surface tailings deposition method. We have a unique situation at Bull River where we have 165,000 tons of mineralized. I have to say mineralized because I don't have a PEA for it, but in another world, I could call it ore. But in any event, it's run-of-mine material that came from those tunnels I described a few minutes ago. That gives us 8 months of pre-production. And so that's at a 1.7% copper equivalent, but the mining's paid for. So the intent initially is to mill that surface stockpile in the first year, and then from there we'll decide which areas of the underground that we would attack from a mining point of view.
Okay, brilliant. Thank you for the detail on that. That's all it's going to take money to do this. Okay, so I just want to understand what's going on at the moment. I know there's a 8.6 million facility, which you've drawn some of that down. You can tell me in a minute what. There's also a long-term. Sorry. Let me get that correct. It was 8 million facility and then 8.6 million long-term debt, which I assume is carried over from the Bull River acquisition. But you have, however, removed 2.4 million of debt as well. So that's the debt side of things and the facility. How much cash are you sitting on today?
We're sitting today about $1.2 million in cash.
Right.
And we're up to date with all of our payables. So that cash position would allow us on basic care and maintenance permitting to move well into next summer if we don't do any more upgrades to the surface facility.
Right. But so let's talk about it. Let's talk about the plan going forward. I'm parking Thierry mine for now.
Sure.
I just focus on Bull River to get this moving to a point where you can pre-process, you can start to mine, you can buy the equipment you need. How much you need to go out to market to raise and when?
Correct. So right now, our business model, we need to raise about $5 million. That would be totally just specifically for the surface upgrades. Those upgrades would include a replacement transformer, a 10 MVA transformer, replacement of the flotation circuit, a new filtration circuit, and then civil works associated with the dry stack. So those 4 projects, we have them in our plan as costing $5 million, but frankly, we've advanced 2 of them. So I put out a press release earlier this morning. I put another one out last week. And so the one this morning, again, was more to give our shareholders an idea that we are moving forward. I mean, when you're waiting on a permit, it's boring and it's hard to measure progress. So, but what I wanted to make sure our people knew is that we own the transformer. We bought it last year for $265,000. We're completing 2 studies with Hydro that cost us about $80,000. And then we have an agreement with Hydro to reconnect to the original 66 kV line. So that project that on paper shows up as $1 million project, we've already invested over $300,000. We'll probably bring it on stream for about $750,000. So in terms of the flotation circuit, we had an opportunity to actually acquire. I'm a fan of Autotech technology, so we had a chance to secure a rougher and scavenger cells from a company. They used to be at Gibraltar, actually, the Gibraltar copper mine and their moly circuit. So they've got a larger circuit now. So we got the old cells. They're bulletproof once they get reconditioned. So so we've got that's a $365,000 acquisition. So I'm quite convinced we'll be able to bring that online for, again, under $1 million. So each of the projects, we are taking some of our funds and quietly advancing those projects. But on paper, we've discussed with a number of parties potentially some sort of either a loan or a convertible debenture of, let's say, around $5 million. That would complete on paper the surface upgrades. And of course, at some point, you alluded to some of the debt that we have. I'd like to return to that in a minute, but we'd also like to eliminate some of our more high cost debt in parallel to that. The biggest thing, or the biggest challenge we've had is we've had the old chicken and egg where people said, well, we'd loan you the money if you had the permit. And I say, well, if I had the permit, the money would be a lot easier to get. So we get whipsawed back and forth. And then I get asked, why not do a pre-feasibility or a feasibility study? And my answer to that, and our board's answer, is that there's $100 million of usable infrastructure sitting looking at us. We've got $23 million metal value in the stockpile that we can monetize in less than a year, and we need $5 million to put it back to work. So do we go out and spend $250,000 to $500,000 to give us a decision that we already have made? So we're in a bit of a unique position, and I don't want to be, again, cheeky about it, but I mean, we just look and say, if I've got $500,000, I'd rather buy the other half of the flotation circuit, install it. And that's really, when you do these studies, whether it be a PEA or pre-fees, they're all about de-risking. And so the question to me is that as our share price moves up, we believe that we will have the opportunity to raise, be it $250,000 or $500,000. That money is going directly into the capital projects. So we're still on track right now. We are waiting on our permit, but the biggest thing, to be fair to government here, is that they had asked for a detailed engineering design for the dry stack. We're just about complete with Stantec Engineering out of Canada here, and that'll be delivered. That's the biggest component that government wants to see. So frankly, they couldn't make their determination on our application without us doing some groundwork. So again, we had to raise money to do the engineering studies so the studies can support what we want to do.
Okay, so
that's in a nutshell.
Talk to me, you mentioned some phrase there which sort of interested me when you're talking about the cost of the debt, because I guess the debt has different terms against different components of that debt. So you want to refinance that out as part of this $5 million raise, but whether it be a convert, a loan, or whatever. So what's so expensive about the expensive bit of the debt?
Okay, so again, the debt is in two components. In order to secure the asset out of, call it the restructuring process, we needed to eliminate at least one of the two secured creditors. And so we borrowed $5 million from one of our insiders, Aaron Matlock, who owns Matlock Farms. So that debt is accruing interest at 14.8%. So we've paid interest on a portion of it, and it's accruing on a portion of it. So about 4.8% has already been paid off for the last 2 years. So it's accruing interest at 10%. So that is real. And then the other half of the debt was when we did the purchase, we offered the senior secured creditor, firstly, 10 million shares of Braveheart at 10 cents. And then subsequently a $6 million convertible debenture over 3 years. So when we set that up, the debenture was accruing interest at 0, 1, and 2%. So very low to no interest over that 3-year period. Early this year, I renegotiated with the principals of that, which we call friendly debt. We decided we wanted to add a 4th and a 5th year, just in case we don't have the cash flows to pay back. So no sooner had we done that than we were able to sit back down at the table, and we negotiated actually an early conversion of some of that debt. So initially, when we did the deal, the debt was going to convert at 40 and 50 cents in year 3, put it that way, year 2 and 3. We reduced the conversion to 20 cents and 30 cents. So essentially right now, we were able to have the underlying debt holders to convert $2.4 million of debt at 20 cents when the shares were trading at 12.5. So that's been eliminated. Those shares, those 12 million shares have been issued. So it's part of the public float you'll see. And the next stage will be to repay the 3.6 million in about 4 years' time, or if the share price gets to 30 cents or in that range or above, they can convert that into 12 million shares. So we consider that as not onerous. The real debt that to me I want to take care of is the 5 million owed to our insider.
Yeah.
Now, you also alluded to 8 million. Now, to clarify, we had entered into a facility with a group called Alumina Partners out of New York. Our feeling was that, it was one of these facilities where every time you drew, it was going to be at an automatic 25% discount. And then we had a number of new investors that said, you know what? We don't like those things, and we're not investing institutionally because of it. So we took heed, and it's not. It was more an issue of timing. Although it was 8 million, the ability to actually draw it in these tranches was somewhat complicated, and it would have been difficult even to draw the full 8 million. So we were able to negotiate with Palisades Gold Corp, who is one of the newer kind of merchant banks for mining in Canada. They've put money in a lot of different outfits. They came in. We negotiated that they would come in at 7.5 cents. So they did that about a month and a half ago. So initially, they came in for an initial amount of about 5 million, and then subsequently we had a lot of interest, both in North America and Europe, and we were able to basically tack on another $1 million. So we raised about 1.5 at 7.5. I would have liked to do it at a higher price, but it allowed us then to put that money to work, and then subsequently we'll be raising money at higher amounts.
So how much did Palisade Gold put in?
I should have it right at, I'm going to say 500. I should
right,
have it
yeah, okay. That feels about right. Okay, cool. Okay.
For 540, I just have to remember exactly because it was a...
Yeah. Promote the bejesus out
of
it. Got it. Sorry, I get all that. I'm just trying to put the numbers together in my head, and I get the timing and the rationale for doing these deals at the point you needed to do them, because it's like spinning plates at the beginning. You're trying to buy something without money. It's always difficult, but you want to clean that up now. So why only 5 million? I mean, given what you're showing or suggesting at Bull River at surface at the moment, I mean, what's that worth you? But you reckon about 20 million. What's the net number that you think it's worth?
Well, I think the net's going to be somewhere. The metal value is around 23 million. The net's going to be around 17. Now that's after smelter losses and that kind of a thing. So we'll net in 16, 17 million. So what we're going to be able to do with that is firstly to repay any monies that we're going to bring in. Let's say we bring the 5 million in the next 6 months, we can pay that off automatically. We'll also be able to remove probably the Matlock loan in its entirety and still have some walking around money of about 3 to 4 million. So that's really first prize for us, is that we would envision that if we assume for a minute that we'll have our permit in early Q3, late Q2 next year, we would mill for about 8 months. And so halfway through, but call it by June of 2022, the surface stockpile would have been completely consumed, but we would be debt free, with the exception of the convertible debenture of 3.6 that's owned to the previous.
Right. So what we're doing here is we're making an acquisition. We're processing how big is it at surface? How many?
It's about 165,000 tons.
165,000 tons. Okay. So in a way, you're kind of clearing the decks, tidying up the balance sheet to kind of stand still, as it were. So the bit that I'm interested in is, What happens then? Where's the real upside to this? I get that you'll be mostly debt free, and you'll have cleaned house, as it were. But where's the upside to this? Going back into a former producing mine.
Yeah. So the upside really is that we're in a unique position with the mine's been pre-developed down 350 meters. So just based on our current resource that was done in late 2018, we have about 1.5 million tons at 2.26% copper equivalent. So again, that grade may not sound particularly high for an underground mine, but because 60 million has been spent on the tunnels, we have total access. The mine's dewatered. It's been maintained in a dewatered condition for 10 years, and we can go right and selectively decide which level or levels that we want to stope on almost automatically. So the main cost that we would have is that I want to do some ground support with probably put some newer bolts in certain areas on the primary tunnels. And but other than that, we could actually go back mining even concurrently with milling the surface stockpiles. So, but what I'm looking at really is to try to say, number one, with government, we want to demonstrate that the dry stack works in our application. And then, so I see that milling of the surface stockpile is really what I would call a proof of concept. I don't need to, I mean, we'll hire the engineers at the time it takes to actually do the detailed stoping. But once you've pre-developed, we're either going to do a mechanized cut and fill or a long hole, or potentially even shrinkage in localized areas. So we've already locked ourselves in to a degree on how we're going to tackle the ore body. But to your point about what's next is we put 5 drill holes down in first quarter of this year below that 350 meter level. So it's what's called 9 level in the mine. But we intersected the same structures 150 meters below the current bottom of the mine. Now, again, it doesn't sound like it's all that deep, but that arguably could then increase our 1.5 million tons. And when I say 1.5 in the resource, that's based at on a 1% copper equivalent cutoff grade. So it really depends on how efficient and cost effective we are at the mining. That could impact the actual resource we have. But there's no good reason that this ore body can't go down 1,000 meters. So we're really at the top of it right now. Once we get back underground, again, I'd like to sink some deeper holes, something again that proves that this deposit may go down, another 500 meters anyway. The real issue is going to be that 2% copper is kind of on the cusp if you've got to actually spend money on the development. But we'll have a nice 6.5, 7-year project without spending any appreciable amount of money in capital. Like the sustaining capital is in the range of $2 to $3 million a year, so it's not excessive. So it will provide a nice little cash flow from this mine. And I'd like to move to Thierry at some point here, but people have said, well, is the money that you're going to make at Bull River enough to do your other plans? And frankly, that'll depend on the size of other things that we're going to tackle.
Right. So
but just on the surface of it, we'll have a junior mining company with positive cash, and call it a 7-year life as a minimum going forward, with the potential it could be a 20-year project. Right.
Okay. So it's self-sustaining, $2 to $3 million. Fine. If you're not going to have to raise capital, you don't need to go through the process of working out the economics in terms of the cost per pound of getting it out of the ground. Okay. So you feel confident that you're going to be in control of your finances to be able to get underground and produce enough cash to be self-sustaining yourselves as an organization. Is that right?
Correct. So, I mean, once the surface is upgraded, it's done.
Right.
The only thing that we'll have to do is at some point would be probably to add a paste plant. The underground equipment, it's a bit dated. So we're going to have to decide, is the cost of maintaining a dated fleet make as much sense as potentially leasing or buying some new equipment. But we have, the mine has been maintained in a kind of a ready state for the last 10 years.
Right. So what do you need to do? I'm just trying to picture in my head. What do you need to do on the basis of what you see today? It's not a huge mine. It's not a lot of pounds, but you are making money each year, self-sustaining, as you say. But if you go deeper, the big if it can go deeper, there's more pounds to be got at, and it could make some money. It's not a big business, but is it going to be big enough to contribute towards Thierry, which I know which you want to talk about now, or does Thierry have to stand on its own 2 feet as well?
Yeah. So number one, people are saying, why are you doing Thierry when you haven't even got Bull River going? And are you abandoning Bull River? What's the message? So for me, I'm saying no. Number one, Bull River is our flagship until it's not. And we are going to put Bull River in operation, demonstrate that we can mine successfully in British Columbia, a positive cash from that. So then we establish ourselves that, Braveheart has done exactly what they're said they're going to do in a province that at times can be challenging from the permitting structures. But we're of the view that it's brownfields, it can go, and as the government has said to me, they don't see any showstoppers here. So, you're near existing mining communities, you got grid power, you got roads, you got everything ready to go. So we're going to put Bull River into operation. And then if I can kind of segue a little bit into Thierry, I saw a really interesting opportunity. Again, I guess it comes back to how people look at the world. I stumbled over, looking at various different projects, and I became aware that Cadillac Ventures, which is a junior mining company, has been around for quite a while. It merged with something called Richview back around, I think, 2008, in that range. But at one point in time, Cadillac has 2 assets. One of the principal assets was the Thierry mine, which is a past-producing copper nickel mine with palladium, platinum, gold, and silver attributes. What we observed there when we looked into it is that they had a PEA that was actually done, a fairly decent NPV on it. I think it was $378 million, and it was done by a group called P&E Consultants. But between 2008 and today, Cadillac had a number of different initiatives going on in those early years, between being in Spain and Peru and 2 jurisdictions in Canada, and they really weren't able to keep the momentum going. They did quite a bit of drilling, all successful. Just about every single hole hit mineralized material, and they were able to significantly upsize the resource there. So I think we've got about, I don't have my screen, I don't have my deck in front, but about 8.5 million tons there. So similar grade to Braveheart, pre-developed underground. It is flooded, but there was a shaft, there's a decline, and there's about 24 miles of lateral developments. So what I looked at there was that at one point, I think around 2010, Cadillac Ventures was actually a 45 million market cap company based primarily on the attributes of Thierry. So this was a mine that ran successfully for 6 years, where they really only went after it was a Belgian company called Umex that owned it, and they principally mined copper. In the latter couple of years, they picked up some of the nickel and then some of the gold and silver. And I think they pretty much, at the time, palladium was only at $50 to $100 an ounce. So they weren't even focused there. Now you've got palladium up at 2,200, 2,300. So it may not sound like a large number, but when I see 0.14 to 0.16 grams palladium throughout the deposit, I get kind of excited, because that could take $5 to $7.50 a ton off the mining costs. So we looked at that, and I said that about 4 years ago, Cadillac had optioned the agreement, or optioned the property, to a group out of Toronto called Northern Fox, which was private. Northern Fox had planned to raise money to bring this property back online and to earn their 70% interest. When I looked at it, I didn't want to be in an option agreement. I don't like them. I said my strong preference is I want to own it outright, 100%. So if we're able to secure the Thierry mine, we'll have two properties that we'll own 100%. Now, if the deal goes through, we'll be paying Cadillac $300,000 cash, 13.5 million shares of Braveheart, and then there'll be a 2% NSR that we can reduce to 1%. So they'll become fairly significant shareholders of Braveheart, but we'll now have a project that's got, on paper, just in the M&I categories in the underground, over $1 billion of metal value. It's also got one significant open pit potential called the K1, and then two smaller pits called the J and the G that again are around 1.4% copper in that range. So I'm really interested in, 0.4% in the open pit, but both the open pits have grades that are similar or better than any of the copper mines that are currently running in British Columbia. So our challenge is really going to be on Thierry is, number one, we want to secure it. Number two, we're going to be issuing, upon securing it, a new PEA to start with. And we'll then have, in my mind, we'll be purchasing an asset for under $2 million Canadian that's got several $1 billion worth of metal. Now, you know, having metal value and be able to mine economically are two different things, but it has a history of being mined before. It's very near an established mining town called Pickle Lake. It's got grid power within 8 kilometers. It used to have grid power right to site, and it's got paved roads right to site. So when I look at projects, this thing has a significant resource to it now. So it's got underground potential, open pit potential, and we'll have to decide again. We're in the very late stages of this acquisition. Cadillac secured shareholder approval a couple of weeks ago, and we're waiting now on the TSX for final approval. Braveheart doesn't need shareholder approval. It's a material acquisition, but it doesn't require shareholder approval. So our intent is to secure that. So now we're going to have two significant assets. The Thierry mine's probably 5 to 10 times larger than what we have at Bull River. So could it become the flagship? Sure, it could. To your earlier question, will Bull River spin off enough cash for us to put Thierry in production? Short answer is no. Not in a time frame that makes sense to us. So we'll have to go out and look for financing, but we don't have any royalties right now on Bull River. There will be the small royalty that we'll leave with Cadillac on the Thierry. But both these projects, and I failed to say this earlier, both the projects, Bull River and Thierry, we've acquired or we're acquiring significant tax losses. So in the case of Thierry, there's about $100 million of tax losses that would be attributable to that property. But what's more impressive at Bull River, and I was a bit remiss in not mentioning this earlier, but when we acquired Bull River, we initially looked at purchasing the assets, but we ultimately bought the shares of Purcell with all the warts that come with buying a company. But the principal reason for that is we secured $152 million of tax pools specifically associated with Bull River. So the Bull River mine will not pay tax for 10 years once it's in production. So again, when I look at the different aspects of how Braveheart tries to attack a problem, we look at all these things and say, you know what, when they're all additive, but we thought that the risk of buying shares made sense relative to the potential to defer tax. So that's our current situation. So again, I'd say we're very close. Cadillac remains motivated to close. We remain motivated. I expect that this will certainly close before Christmas, but like everything, there's particular hoops that you have to go through, but there's nothing that should derail it at this point in time.
That's amazing. I didn't spot that. The tax loss position is significant, not now, but it will become significant in terms of making it attractive to potential acquirers, for instance? Or if you choose to go that way yourself, obviously that's quite beneficial indeed. But first of all, thanks very much for running through that. I mean, my next question, I think, is, does this set the pattern? Does this set the tone in terms of M&A going forward? Are you still going to continue looking for other projects as well? Or you, as your shareholders pointed out, get focus on Bull River, get this transaction with Thierry over the line and get focused on getting in production? Or are you acquirers?
It's a great question. And I don't know if I'd get scalped if I went to the board with another acquisition, but this, I mean, the one that we're trying to do with the initial one with Bull River was considered to be a bargain acquisition, is what the accounting folk called it. So it was certainly accretive to the company, and it really changed where we're going. This one, if we were able to bring it to the conclusion, is significantly more accretive. So we'll look, really. I mean, I'm not really of an interest to go pick up a property and do primary exploration for 10 years and drill and drill and drill and then flip it. But I think that Braveheart is going to get on some radar screens with some bigger players. We're still a little bit small for the mid-sized copper producers in Canada, but Thierry could be that kind of an asset that someone says, you know, how did they get that? How did Braveheart pick that up? So we might have some partners come to us. Clearly, with copper at 350, there's people that are now interested in copper who weren't 6 months ago. And so, you know, so would we look at other things? I would say, just based on my experience and most of our directors, we're going to be a North American-based company. I mean, I think we'll look for value. I've spent half my working career up north and beyond the tree line, and projects that take tremendous infrastructure to get going. So there are some mega projects, but I don't want something that's going to cost $1 billion to build. But if we can build, for example, the PEA that we'll be looking to do on Thierry will be likely a 4,000 ton a day underground operation, similar to what it was. So if you could build that for 175 million, that, you know, you don't have to, you can probably get your head around that kind of financing without even having a partner to get involved there. So I want to watch that we have a project that on paper looks really good, but the capital component is so daunting that you don't get started and you miss a cycle. So so that's right now. I mean, we see ourselves clearly as a copper player. I really like the idea that we've got some palladium potentially. There are other companies that are sitting physically located between Pickle Lake and let's say the North American Palladium mine near Thunder Bay, Ontario. So that whole belt up there is blessed with copper and nickel and the PGMs. So that's, I guess the other thing I like is that we're now multi-jurisdictional. So Canada in general is considered a safe country to be investing in, but now we have two separate provinces that are both historically very pro-mining. And but we'll continue to look in largely Western Canada, but also, you know, for opportunities in the States. And if we can see some situations where we could add assets without having to spend a lot of money to acquire them or to control them. Because quite often what you'll find is that junior mining companies will enter into these agreements where they put a little cash down and then they commit to these work commitments over a period of 4 or 5 years, and they're 1 year in and they can't raise the money to do the work commitment. So some of these things tend to fail, and that's really, in my mind, what happened with Northern Fox, is that they had great expectations, but they never raised any money. And so at the end of the day, that's where I don't like certain option agreements, because if you can have it free and clear, then you can decide where and when to spend money and how to create value.
For sure. Stay in control of all of this.
Yeah.
Look, Ian, I'm just kind of conscious of time here. Maybe you can come back on and we can drill down to a couple of those things, especially around Thierry. I think I'd be interested to understand how you could move that forward. But first of all, get it under your belt. Get that approved. I'd like to also just sort of see where you end up with regards to this restructuring of the finance, because I think that's critical to get tidied up, especially if you are going to go back out to market. People want to see a tidy balance sheet to all of this. But I've enjoyed hearing this story. Copper's going to be big for next year. We keep saying that, and I think it's going to be true for 2021. So appreciate your time today. Pick up the phone, let us know how you get on, okay?
All right. Thank you, sir.